A manager has a hedge fund incubator. For 18 months, she trades proprietary capital. Now she wants to take outside investor capital before a Regulation D private fund offering and use those results for track record marketing. This is Syndication Attorney Field Notes with Tilden Moschetti. Today's field note is about hedge fund incubators, private placements, and the investment fund capital raise that comes after the testing period. The sponsor question is simple. Can I use an incubator to build a track record, take a little money from friends and family, and later market the returns in a Reg D fundraise? The short answer, an incubator can be useful. But a hedge fund incubator is a business phase, not an SEC exemption. The word incubator gives you no legal protection. If you are trading only your own money, you may just be trading your own account. Once passive outside investor capital comes in, the project can move into securities offering territory. And once you start showing returns to future investors, track record marketing rules matter. That is the frame. The common mistake is treating the setup as if it solves the legal issue. The manager forms an LLC, opens a brokerage account, funds it with personal money, trades the strategy. The account has real statements, the returns look real, so the whole thing feels official, but the LLC is only an entity. It is not a private placement. It is not a PPM, meaning a private placement memorandum, which is the main disclosure document for a private offering. It is not a Regulation D exemption, and the broker is not there to tell you whether your capital raise is structured correctly. This is where the phrase proprietary capital matters. Proprietary means proprietary. It means your own money, not your brother's money, not your roommate's money, not a small check from someone who likes the strategy. If another person puts in passive money and expects profit from your work, the analysis changes. The relationship does not override the law. Friends and family can still be investors. A handshake can still be a securities offering. A side letter can still be a securities offering. Calling the vehicle an incubator does not change the economic facts. The clean distinction is this. On one side, you have proprietary trading. You are testing a strategy with your own funds. You are not selling an interest in the strategy to someone else. You are building data. On the other side, you have a private fund capital raise. Investors put in money. They do not trade. They rely on you. They expect a share of gains. That usually calls for a deliberate Regulation D private placement structure. The choice of path also affects marketing. Rule 506B is the quiet path. It is built around no public advertising and real pre-existing investor relationships. Rule 506E allows public marketing, but it comes with accredited investor verification. So if you post your returns online before choosing the path, you may be making that choice without meaning to. Let me put it in a simple example. Maya is an emerging manager. She forms an LLC and trades her own money for 18 months. She keeps the strategy tight. The brokerage statements show strong gains. She starts to think, I have enough now to raise a real fund. So far, that can still be phase one. It is her money, her risk, her testing period. Then a college roommate says, I believe in you. Put in $50,000 for me before the fund launch, no paperwork needed, track it on the side. Maya says yes. The roommate does not trade. The roommate just waits for Maya to create returns. That is not just a friendly favor. It can be outside investor capital. It can move the setup from proprietary trading toward a private fund offering, and it can raise investment advisor registration questions, including state-level questions, even if the amount is small. Then Maya posts on LinkedIn, up 38% in the incubator, opening to outside investors soon. Now, there is a second issue. The capital issue was one line. The marketing issue is another. That kind of public post can be general solicitation, which is a legal way of saying public advertising. It can affect whether Rule 506B is still available. And the returns themselves are not ready for marketing just because they came from a real brokerage account. A spreadsheet of returns is not the same as a marketable track record. If performance will be shown to investors, the SEC marketing rule enters the picture. In plain English, that means the numbers need support. You need to be able to prove them. You should not cherry pick only the best months. And gross returns with no fund expenses and no management or performance fees may not tell the real story. This is the net of fee performance point. In an incubator, you did not charge yourself a fund fee, but a real fund might charge fees. So if you show incubator returns later, the presentation may need to show what those returns would have looked like after model fees. That can be very different from the raw number on the account statement. Expenses matter too. If the data feed, software, research tools, and other costs were paid from your personal bank account, the trading account may look better than a real fund would look. Serious investors will ask about that. Regulators may ask about that. The cleaner you keep the records from day one, the easier the later discussion becomes. This is why some managers bring in a fund administrator during the incubator period, even before the full fund launch. A fund administrator is a third party that helps keep independent books. The administrator does not make the offering legal by itself. But third-party records can make the performance record easier to support. A few assumptions are worth clearing out. Do not assume the incubator is an exemption. It is not. Do not assume friends and family money is outside securities law. The relationship does not decide the issue. Do not assume the LLC is the final fund. Often the cleaner structure is a new fund entity with a separate manager or general partner. Do not assume gross fee-free performance can be shown without analysis. Track record marketing has its own rules. And do not assume federal assets under management numbers answer every advisor registration question. State law may matter even when the account is small. The field note is this: treat the incubator as phase one of a planned transition, not as a loophole. If you are in the incubator phase, keep the capital proprietary, keep clean statements, track real costs. Think about net of fee performance before you need it. Decide whether the future private placement will fit a quiet rule 506B path or a public rule 506C path before you start promoting returns. A good incubator proves a strategy. It does not replace the fund structure. It does not turn friends and family into a special legal category. And it does not turn raw returns into investor-ready marketing. The real question is not, can I call this an incubator? The real question is, do I know where the sandbox ends and the regulated offering begins? The longer written version is in the show notes.